Okay, good afternoon and welcome to our webinar on leveraging today's booming M&A environment to achieve your business and personal goals. My name is Jim Herrick. I'm going to be the moderator today. And before we begin, I've just got a couple of housekeeping items. So first, during the presentation, please keep yourself muted and camera off. Go ahead and turn it on if you want to, but maybe for the best experience, we'll mute. And then under the view button on the top right, if you want to click speaker view, I think that'll give you the best experience to at least see who's talking. And for questions, hopefully some questions come up during this. There's going to be a chat feature at the bottom. You can use that to ask your questions, and only myself and the panelists are going to be able to see those questions. So there is some anonymity there. And finally, a recording of this webinar is going to be made available in the coming days as well. So if there's people you think would benefit from the content from today, there will be some link to the recording to be able to share as well. So let's begin. After a record-breaking year for M&A in 21, and I think there's optimism for another year in 22, we're lucky enough to kind of focus on the topic today with just a field of experts in mergers and acquisitions. And we've got lots of good questions for them. Many of them from you guys are our participants as well. Today, the panelists include Brady Fineski, President and Lead Strategist of TDC Investment Advisory in Maumee. We've got Dina Jalbert, CEO of Align Business Advisory Services, a mergers and acquisition firm out of Florida. We've got Doug Miller, who is a partner and specialty risk practice leader with Kapnick Insurance. And we've got Mr. Mark Karchner, partner and M&A practice lead at William Vaughan Company. Thank you guys so much for joining us. So let's jump in. First question I have is a little bit more broad, and Dina, I'm going to pose this one to you. Why are so many business deals being made, especially in the lower and middle market? And what are the trends to keep an eye out in the coming months?
Absolutely. Well, thank you. And thank you for the opportunity. 2020 and 2021 in particular were really strong years for M&A volume, and it's certainly continuing into this year. And the reason for that is because we're in a situation where there is an abundance of cash available in the market, more so than any time in any of our history. So as an example, the private equity world, private equity funds have raised approximately $2 trillion of money from investors. And that money has been raised and is on deposit in banks looking and waiting patiently for a home. Most private equity deals also use 50% leverage. So that's actually almost $4 trillion of money that is sitting on the sidelines that has to be deployed. And that money has to be deployed within a specific amount of time, or it has to be returned to the shareholders. So there's an urgency and a time limit on this money. And that money was raised all throughout 20 and 21. And some of it, frankly, is even older than that. So a lot of money that has to go somewhere. As well as there's quite a bit of cash available on corporate balance sheets. Cash on deposit is the highest it's been in history. And so corporations who perhaps struggled a little bit coming out of COVID and kind of rebounding, shareholders want growth regardless. And the fastest way to growth is through acquisition. So you've got, private transactions taking place, and you've got corporations also looking to buy and grow. And what is particularly of interest to both of those pools of buyers in the lower middle market is the ability to consolidate. So you can go and buy several small businesses, or smaller, not necessarily small, but smaller businesses, and pool them together to create a larger enterprise versus going and buying one much larger business. And the reason for that is you can scale that much faster. It's the age-old speedboat and the aircraft carrier. The speedboat is smaller and can cover more ocean quickly, which means the velocity is higher and your return is going to be higher, versus you buy the big aircraft carrier and it doesn't move and pivot as fast, and you're only going to get so much growth year over year. And so hence, and we're seeing corporations and private equity investors follow the similar path of it's ideally better to buy many and consolidate versus either building it yourself and or buying something larger. It allows you to diversify as well and grow at a much faster clip. So all of that means there's just tons of money all competing for really good assets, hence valuations remain really strong and the deal market is really strong.
Thank you, Dina. And so it's obvious the landscape is good, the money's out there. I'm going to shift over to Mark to maybe get more to the core of why businesses and companies do transactions. So Mark, like what drives these transactions? Why do business owners want to sell? I mean, other than obviously earnings drives a transaction, but what other things drive the transaction in these sales?
Yeah, Jim, I think I think the important thing to remember is transactions are usually done to achieve either a business goal or a personal goal, right? It's important to remember that transactions are generally not a goal in itself or a fundamental strategy, but a means to achieve something, whether it be, here again, a business goal, personal goal. So, I mean, I think it's terribly important then to understand, make sure you understand what your goals are, right? What's clear, and be clear about that. So you can structure a transaction or maybe another avenue to reach those goals. And I think much of the M&A discussion surrounding middle market companies is around the middle market owner, founder, managed business, right? And it centers around the succession of that business and the quote transaction that takes place surrounding that. So when you think about that, in every sense, every owner out there is going to go through a transaction, whether they like it or not, right? Father Time is going to win that battle, right? And they're going to have to do something. The question is not that they're going to go through one; it's how do they choose to manage and control the process, right, to meet their goals, which may include everything from liquidity to retirement, family succession, legacy, community, just all across the board on that. I think on when you think about a buy-side transaction, okay, not a business succession, but where I'm actually going to go out and do a buy-side transaction, it's typically going to meet a business goal, right? You either want to increase scale, new markets or products, new technologies, customers, maybe key employees, resources, those kind of things I think are there. So my typical comment is, let's make sure we know why we're doing a transaction and what are we achieving by doing it, right? And that's all upfront. That's an upfront kind of conversation. When you talked about value drivers, let's assume we're talking about monetary value, right? That's usually what people circle in on. And yes, earnings is a large part of that, right? I think it's important to remember it's earnings that the buyer is going to expect to receive, right? I mean, they might use history as a proxy for that, but it's what they expect to receive. And the other thing that people don't think about a lot, it's also the risk associated with receiving those earnings, right? What are my risks involved? I mean, risk matters. We all expect to have higher returns on investments when they're higher risk, and we accept lower returns on investments when they're lower risk. That's why a $4 million earning, let's say a business earning $4 million might be worth more than a business earning $5 million because of the risk profile of that. So things like customer or product concentration, quality of management teams, intellectual property, all those matter. And if you do enough reading on this, you hear about the proverbial moat that surrounds your business, right? How's it protected and how's your earning stream protected? Those kind of things matter. Other things are things like size and scale, right? And the amount of investment that maybe a business requires, the amount of investment in working capital or CapEx, all those kind of things, impact that as to value.
Yeah, Mark, appreciate that. One of the things you mentioned in there was the process of the transaction. And I think we'll go through and touch maybe all parts of that process, but one of the earliest parts of that process is considering or deciding to sell the business. So Brady, I'm going to shift over to you. For those that are considering a sale, either now or in the future, who would you say are the most important players to have around the table? And what do you think is the most important thing for them to address when considering to sell their business?
Yeah, well, I think it's an honor to follow Mark because, certainly Mark would be on my short list of people to surround the table. And he and I will probably sound quite a bit alike because we've done a few transactions here recently. And I think what he stated is really, really important. And so, the right advisors around the table are important and the right steps in the process personally as well. So I'll come at this from a little different angle than the others in that I'll talk about personally, how do you prepare for the decision to sell, or if we're going to sell, how much you need and want, right? And so I think the most important thing on our side, pre-sale, probably the most obvious thing would be, how much do we really need and want? What price do we have to get after tax in order to have the lifestyle and the income and the legacy that we want for our family? And sometimes that number might not be as big as you think. Sometimes it might need to be bigger than what you think you can get at this time. And so that's kind of the obvious answer, but probably the more important answer is to make sure that you also spend some time with those advisors, really determining your purpose. And will this liquidity event, will this cash help you, or how can this cash or liquidity event help you accomplish that real purpose in life? And so a lot of times for us, as many of you know, we spend a time going through a process for, right? Really determining what the wealth is for, making sure that husband and wife are on the same page, making sure that those priorities financially are set so that as you approach the transaction or the liquidity event, we can do the right planning. If charity is super important to you, there's some really smart tax things and ways that we can structure a great charitable gift prior to sale, prior to obtaining an LOI. So getting the right advisors, determining that purpose early in the process is important. If family legacy is the most important thing for you, even though there might not be a family member in the family business, how can this wealth still carry on that legacy? Well, there's a lot of estate planning and taking advantage of the current laws at the time. There's educating the family that needs to take place prior to that sale so that everything's ready when it happens. Just like when you're getting ready to sell your business, you're going to sharpen your pencil, you're going to look at contracts, you're going to dress it up and get it ready to go market. Similarly, your personal financial situation has to work side by side in that thought process, because the money's going to fulfill the financial plan, but what's going to really fulfill your purpose? And how can we make sure that they go hand in hand and that this experience is off on a course or a direction that does both, right? So I think that's how I'd answer that one, Jim, and the earlier the better.
Yeah, amen. And I think, as you mentioned, the purpose, I would imagine, is unique for every family, right? So as we know, each business, each owner, each family is unique compared to the next one and the next one. So Dina, back to you real quick. So what would you say, in your experience, are the key factors owners should be considering when given their unique situation?
Yeah, I think, in line with what Brady was just articulating, you have to check those boxes, or well, I guess I should say, determine what your personal needs and wants are. That's critically important. But then you also need to look at the business in a similar way. And where is the business in its life cycle? What level of sophistication is it at? Mark mentioned earlier about size and scale. And kind of take an inventory of where the business is, what it has, strengths, weaknesses, opportunities. All of those things matter. And timing, timing is key and important. It's the age-old, buy low, sell high, right? And as I said at the outset of today's meeting, valuations are at the highest they've been some time due to the competition that is being drummed up by all of this capital chasing opportunities. And so, you want to have your business prepared to be opportunistic so that you can go out very strategically and thoughtfully into the marketplace to sell your business. Oftentimes what we see is a lot of business owners look at mergers and acquisitions as the end point, that the world ends and stops, and that it's more of a retirement driven activity. And it certainly is, and all of the things we were talking about in terms of understanding your personal liquidity and all the things that you need to have. However, you don't have to start to prep for it and or start looking for opportunities until retirement. There are many ways to structure a transaction that you can work in the business for another 10 years if you want to, and have the opportunity to still reap in the growth and the expansion of the business subsequently with a partner. Maybe you don't want to do that, and that's fine too. And there's many ways to do it, but really one of the number one key factors is timing. What I see a lot of business owners do is say, well, I'm having a really great year. The business is throwing off a lot of good cash. Life is good. Why would I want to upset the apple cart? Well, because what is that income that you generate, or that cash that the business throws off every year? You might get, X amount per dollar today, but if you wait 5 years, it may or may not be the same. And many, especially in times of abundance, which is what we have been in historically, the grass is always greener. Well, I'll just hold on to the business and wait and have it maybe generate another $1 million in EBITDA, and then I'll sell it and still get the 10x these people are talking to me about today. Well, that opportunity cost isn't the case, because there's many factors to consider beyond, just multiples or just valuation. So what if you lose a large customer? What if the expectations for growth actually don't hit? There's a lot of operational and strategic things. So similarly, that when you sit down with an investment advisor, like some of the very smart folks we have on today's call, it's really important to sit down with someone like ourselves, so that you can think strategically through where the business is and where it can go, and making sure you're lining up the timing. And we can also help you understand and see what's available in the marketplace, and whether that will be, as I look forward, 22, all that money still chasing, multiples are high. However, supply chain is tough, costs are up, and that eats into margins. So when your margins and your profits start to go down, valuations will start to go down, because the cost of fuel and just everything's 8.6, I think, more expensive than it was. And so you have to think through all the things. If you have to carry those continued higher costs for 1 to 2 years, that's going to continue to eat away at your margin. So that whole idea of, well, I'll just wait 2 years and then I'll trade and I'll still get 10x. Well, you probably won't. And so but maybe you will. Maybe it's the opposite in the future. Times are better, and you've got a big growth trajectory that you want to hit on first. You just have to think through all those things. So I would say the number one key factor that owners really need to look at is timing for the business, but also for themselves. Like, how much more do you really want to do it? It's your life's work. You put a lot of blood, sweat, and tears into it, and maybe you're just tired, and that is okay. And we tell clients all the time, there's never a wrong answer. You just have to ask that introspectively. And if you are done, do you have the key people to succeed you? Because that also has, a value consideration. So timing, both personally and for the business, I would say is the top number one factor that a business owner should look at.
Yeah, great. Thank you. I think that goes back to what Brady said earlier about having the right team of advisors around the table. And I think everybody's going to have their value. As you mentioned, the timing's got to be right from the financial aspect and multiples and revenue. But I think the timing's also got to be right from the purpose aspect, which is why I think that that exercise Brady mentioned is so darn important. One of the other key people at that table, I think, has to look at risks and what preparations can we do to minimize some of the risks. So, Doug, as I go to you here, what do you think some of the things that business owners or sellers of businesses should be thinking about in terms of insurance when they're contemplating a sale, and when should they inquire about it, right? So maybe that's the last thing on their plate as they're thinking about things. So from your perspective, what should they be thinking about and when?
Yeah, thanks, Jim. Appreciate it. Yeah, the main thing we like to remind people is that the corporate insurance portfolio is, in fact, a financial asset of the corporation. And to a large extent, it can be portable. It can go with the sale of the company. People don't necessarily think of it in that way, but it is certainly an asset similar to property, plant, equipment, other financial assets, intellectual property. I can assure you that these days that asset and that portfolio of insurance is being heavily diligenced by buyers. They expect that you have optimal coverages in place. We're starting now even to see more sell-side insurance due diligence that's being done to kind of highlight the fact that maybe we're a conservative company in terms of our outlook on risk. We buy a lot of insurance, but not too much insurance. We have sort of the optimal coverages. We don't have any major gaps in coverage. and that can really make an impact on quality of earnings and even multiples. So it is something that people don't think of normally first. Usually they think of it kind of last and at the end. And the other thing from a seller's perspective, from an insurance standpoint, that's really important in most deals, whether they're private equity driven or strategic deals in general, is reps and warranties insurance, which can provide sellers with a very efficient way to get a clean exit from a sale of a company. So it can reduce, or in some cases potentially eliminate escrows, reduce indemnity caps, and really make the transaction go a lot smoother overall. In terms of when to consider, I mean, we always like to say as soon as possible. Normally on the rep and warranty side of things, we really need to get involved at the point when you countersign the LOI or at about that time. And then in general, just if there's any kind of impediment to the deal as you're going through the process between the buyer and the seller over whatever the issue is, it's usually a good time to give us a call, because there's some pretty creative insurance solutions out there for some of those impediments.
Yeah, so early on, sounds like the right answer there is to get the insurance expert involved. You know, without getting too far into the weeds here, Doug, you know, if I'm selling a business, I want to know what the buyer is looking for. So what does the buyer want me to have addressed, or what does the buyer want me to have insured specifically that maybe I haven't before the transaction?
Yeah, typically, buyers are generally, in my experience, most concerned with sort of a low frequency but high severity risks that may be out there, the more kill the company or hurt the balance sheet type of risks. So those tend to also be what we call long-term liability risks that may take a long period of time to develop into an actual financial loss, and may take a long time throughout the litigation process. So examples of those would be things like directors and officers liability, cyber, data security and privacy, products liability, or anything to do with warranties that may be hanging out there, and environmental would be the typical types of risks.
Well, and as a follow-up to that, so not every company is perfect, right? Not every company is blemish-free. So what if there are already known issues that exist in a business? Can I not sell it, or are there ways to kind of get around that?
Yeah, that's the thing that people are really surprised, is that you can insure the burning building in our business. And there's a really surprising amount of insurance risk capital that's out there just looking to insure those types of risks. So the most common example of that would be a scenario where the target company has open corporate litigation that has not yet been resolved while they're talking to a potential buyer. It could be any type of litigation, but one technique is to cap that. So to essentially offload that excess risk to a third-party insurance company, so that there's some deal certainty around the number or the quantification of that potential loss, so that it really doesn't have to be something that the buyer has to worry about or the seller has to worry about. There's things like judgment protection insurance. So if your organization is secured a judgment against a third party, and say a significant dollar amount, but you're concerned that could be reduced on appeal, that delta can be insured. Conversely, if you're a defendant in a claim and you have a zero or low settlement and you're worried that could go up upon appeal, we can cap that as well. Pretty much any type of risk that's already out there, as long as it's been diligenced and there's some third-party information about it, there's a price that can be paid in terms of premium to mitigate that type of risk. So those would be the main examples. And then the other example would be tax. If there's tax risk, maybe we know there's a risk, but we don't know how much necessarily, and we don't exactly know what are the odds of that particular risk. If the main economic rationale for the transaction is based on a particular tax position, there is insurance for that as well that can help, soften that for both parties, the buyer and the seller, and kind of take that issue off the table and again, facilitate the transaction.
Appreciate that, Doug. It's almost like you knew where I was going next. Good segue into tax, right? So Mark, more generally, I guess to you, is when and how should a business owner look at the tax impact of selling a business?
Yeah, I mean, Jim, I think, very simply, right now and on a regular basis, right, is laws and opportunities change. I think it's important to realize, and this is, common sense, but what really matters to a selling shareholder is not necessarily the purchase price, but what they put in their bank account, right? And taxes are a big part of that equation and how I get there. So, we all know and read about the numerous levers that need to be pulled or not pulled in terms of entities or transaction structures and all that kind of stuff. My advice would be to get out ahead of that and simply ask, even today, how would my business be taxed if it was sold, given the way I sit now under some typical scenarios that I might sell it under, and allow you to look at that and decide, what I might do to maximize my proceeds and doing those. What can I avail myself to? It's easy to forget about that as when you're operating a business and time goes on. And I would also say that, reiterating what Brady said, right? Don't forget about taxes after the sale, right? So estate taxes, gift taxes, all that kind of stuff that can come into place afterwards. You might argue it's not going to impact you, but could have a significant negative impact on your heirs or wherever you're deciding your financial resources are going to go right after you. And quite honestly, it would be a shame if that happened, given the tools that are available and are out there and folks that can help you. So I would say, don't forget that aspect of it. And so I guess if I was summarizing, I would just say, I've very seldom ever seen a negative tax consequence of dealing with something early, right? And thinking about it. So work yourself through that, get good advice from people who work in transactional areas and can help you with that. But there's no reason you're not looking at that or thinking about that long before you're doing a transaction, because I typically during a transaction process remind people, don't let taxes, don't let the tail wag the dog on stuff like that. So you'll have a lot of moving parts when a transaction is going, but taxes are some things that you can structure and things that you can manage and you can do early, right? So.
And staying on that vein, Mark, on pre-sale, obviously there's a lot to think about, a lot to prep for. What about a company's financials? How important is it to keep those in order prior to sale, and for how long prior do we make sure those are in order?
Yeah, I think that's that's a good point, right? When people come about their financials and prior to sale, first and foremost, I typically say keep them simple. For a lot of reasons, right? Transaction wise or otherwise, keep your statements simple, easy to understand. Have them be accurate, but I often use a term that I talk about, useful accuracy, right? A degree of useful accuracy. Let's do, have those things be in place, and that's going to help with things like timeliness of those statements, consistency, availability. Be conversant on your financial statements. Understand, what's in them. Understand, well, what's different from last year, or what's different from my budget. Be able to speak to those, in a way that that makes sense. And those are all good to operate your business too, right? Those aren't just things you would want to do just for a transaction, but they really come in the spades there, right? And you can think about it because all those things give buyers credibility on your numbers if they're dealing with financial statements that change and can't be reconciled and all. It just throws doubt into them, right? Even in what you're showing. So those kind of things are important. If you're not doing GAAP statements, I would tell you to think about why not get yourself to GAAP statements, right? That can be handled. Think about an annual audit or review, those kind of things, right? And whether that's applicable or is a good choice for you when you see those. Another thing that I would say, just in a little bit different vein, but I think is very important, is, get your working capital under control, right? Working capital being out of control when you head into a transaction is going to do nothing but hurt you, right? It's going to cause noise, it's going to cause confusion, and it's probably going to cost you dollars. So get that under control and manage that as well. So I would think about just the blocking and tackling and simplicity, and if you're having trouble with all that, stop and ask for help, because it can be, this is another thing that can be managed. It's another thing to be managed. There's certain things you can't manage. We can't manage what the economy is doing today. I can't manage interest rates. I can't do those kind of things, but I can sure as heck manage some things internally on this and this kind of stuff. It's easy for me to say. I'm not saying it's not difficult, but most people can get their hands around their financial reporting and getting it in a way that just helps your business and helps the transaction.
Yeah, so control what you can control and prepare, right? And I think we've talked a lot about pre-sale and preparation. So now let's talk about through the sale. One of these terms that gets thrown around all the time is due diligence, and some people view it in a negative light. But really, what is due diligence process, both on the buy side and on the sell side? Mark, staying with you, because I know you've got a lot of experience in this.
Yeah, when you think about due diligence, right, and everybody talks about it, everybody feels like they've seen it, and anybody who's been around has seen more lists that they can shake a stick at as to what due diligence is. But I think when you think about it, just fundamental basis, it's a buyer trying to confirm the key attributes as to why they want to buy your business, and then how much they want to pay for it, right? And those are two different things. I often talk to people about who are buying to say things like, when we go in, is, so what are the things that are either present or not present that would keep you from doing this transaction at any price? It's just not going to be worth it to you. What are those things? And I suspect there shouldn't be 20 of them. Maybe there's 3 of them, but we would not want to confirm those kind of things. And then there's always the question of value, right? How do I decide what my value is? And I got to confirm a bunch of stuff because I've got certain assumptions I make about what it's worth and so forth. So I think it's a process where they're trying to confirm those key attributes. So you think about that. So typically it's performed by third parties. It's usually a very intensive process. Okay, a lot of data being thrown around and covering more than financial. It's covering financial, operational, probably market studies, any aspects of your business, depending on the kind of buyer, the type of buyer, and what they're used to doing. So and then you mentioned, sell side due diligence, right? Which is a common process where a seller says, before they even engage with a buyer, they say, I'm going to have due diligence performed on myself, okay? And all those things I just talked about, but I'm going to have that performed on myself before I engage with a buyer. Now, why do that? Why put yourself through that? There's effort to that. There's some cost to that, all those kind of things. And quite honestly, it's to help you anticipate and prepare for buyer concerns, right? So you're going to try to identify things ahead of time. They can say, well, this is a legitimate buyer concern. How am I going to deal with that? And work with people like, Dina, to get your strategy around how am I going to deal with that kind of stuff? I'm going to identify that. I don't want that as a surprise 3 weeks before I'm trying to close, right? Then at that point in time, your leverage is different in a transaction. All kind of things happen. So basically help you identify buyer concerns, tends to increase or accelerate timing, right? Gets things done faster. And quite honestly, in a big piece, I think it also increases the probability of closing a transaction when you deal with stuff, deal stuff early. If I was giving a bit of advice about due diligence on a sell side, and while it might be perfectly acceptable to stage the availability of sensitive information during the process, and I think that's okay, and you see that at times But I would tell you, don't play hide the ball, right? Don't get everything out there. If you have issues, and who doesn't? Jim, you just said that a minute ago. Who doesn't have issues? Get them out there, get a strategy surrounding them, and get them on the table as early as possible, because it's just a natural progression as a seller. As the transaction goes on, I'm a big believer, you just lose less leverage. You always can say no, and everybody says that, but the reality is you get closer and closer to the finish line, it's a little bit harder to do that. So deal with those things up front.
Well, and I would imagine the length of time that the due diligence process takes, or whether or not it's a headache or a cakewalk, has everything to do with what we've talked about so far.
Yeah,
Pre-sale preparation.
sure does. And confidence in the business, and Dina, you comment on that a little bit, or?
Yeah, I was just going to say, this is the area where we see deals get retraded the most. So someone makes an offer on your business for X amount of dollars, and you get very excited and you're like, great, I'm about to sell my business for X millions of dollars. But then you go through the due diligence process and things are found. The buyer is going to come back and say, yeah, I know I said I'd pay X, but I'm only going to pay Y now because of this, and this. And it's oftentimes a surprise, and it's frustrating, and emotions are high. And as you all were just saying, the process is lengthy. Deal fatigue, as I call it, starts to set in. You're just tired, and it risks deals from even closing altogether. But the number one area where we see the value retraded is in due diligence. So the amount of preparation you can do in advance to mitigate that will definitely not just save you a few dollars. It will protect the deal altogether, but then also save you millions. So it's worth going through, especially a quality of earnings exercise. That's usually where we see the most retrade happen, around the financials not being accurate, and there being some issues there that need to be resolved.
I would just add too, the due diligence is completely what the underwriters look at in terms of the rep and warranty insurance. So if you're looking for that clean exit, if it's sell side policy, they're going to look at sell side due diligence. If it's a buy side policy, they'll look at the quality and breadth of the buy side due diligence. That's 100% of what the underwriters rely on in order to get those deal facilitation products out in the marketplace. So it's helpful in that regard as well.
Yeah, awesome. Thanks, guys. We've talked a lot about pre-sale. We've talked about the due diligence process. What we haven't touched on yet is when the deal happens, post-sale. And so, Brady, I'm going to pose the same question to you that I posed to you earlier, except instead of pre-sale, post-sale. So after it's all done, the deal's done, what do you say is the most important thing for families or business owners to consider or do?
It's a good one. So I think about two things. I'm glad Dina mentioned deal fatigue, because, I think it's very common, right? And it seems like all I want to do is get this thing done and go play golf every day. And yet having a transition plan that is filled with peace, however you define that, becomes very important, because those that stop working on a Friday, have the money wired to their account, and then don't work on Monday, I think we see them tend to struggle through this process a little bit more through post-sale than to have a transition plan. And as Dina mentioned, there's lots of ways to structure a deal. So, part of this too is making sure that you can envision, have a vision of what that post-sale waking up that Monday morning is going to look like, how you're going to be engaged, how you're going to fulfill purpose, and all of that, right? And just hearing all of these things and due diligence and what you need to do in advance, it just makes me think about a study that says 97% of someone's wealth that was generated is gone by the third generation if they don't do one very important thing. It's easy to pass on dollars, it's easy to pass on wealth, but it's very difficult to pass on the values that created the wealth. And therefore, by the third generation, 97% of the time, that money evaporates. And so if this is an event for your family that is a game changer, or perhaps changes a family or changes a family business dynamic, it becomes very important that you remember and you capture post-sale, if you can't do it in the middle of the knife fight of trying to sell it, all of the things that took place, the stories, the struggles, the journey. I just heard a company tell a story the other day about how they couldn't make payroll way back in the day when they had 8 employees, now they have 600. They couldn't make payroll, so they went out to the back of the shop and filled everyone's cars with gas and just asked them to come back on Monday because they promised they'd make payroll the next day. Those stories, how are the grandkids going to know that? How are the great grandkids going to know that? And so capturing those stories, those struggles, I think most of the time we hear those moments are the moments that bring the most joy and fulfillment, not the day the money gets wired. And again, it's easy to pass on that wealth and the dollars, tougher to pass on the values that created it. So I think post-sale, spending time recapturing all of those events, the stories, the struggles, and figuring out now, how do we pass that on through the next generation, since we're not going to pass on the business. I think those things become very important post-sale from the personal side of this conversation today.
So Brady, if I'm a business owner, I sell my business, I agree with everything you just said. My next question will be, how do I do that?
Great conversations, right? And that's between husband and wife, that's between your advisors, but it starts with just great conversations. And of course, there's some tools that can help you do that, that are out there and available that a lot of advisors use. There's some tools, but to really kind of first discover what those stories are, to be able to figure out how you capture that, and then how we transfer that through family meetings, through planning, just through great communication. And oftentimes that's a gap within families. And then adding liquidity on top of that makes it even harder. And so I think thinking about that and having a vision of what that transition plan is going to look like, is this liquidity now going to become a new plan for purpose, right? And how do you connect that wealth and purpose in a plan that now becomes your job to engage in that and to make sure that that's passed on right? All of those things we see keep people pretty happy. And money can create a lot of problems, as we know, but those things become very important. I think post-sale gives you a different type of purpose, a different type of engagement around this great benefit that's been achieved through a sale.
Yeah, appreciate that. If nobody else is going to jump in on that one, I am going to go to some of the questions we've got from the participants. I think we've answered almost all of them. There is one that, Mark, maybe is a little specific, but I think you can answer this one. It's written, are there different tax implications if the company is sold via an ESOP versus private equity?
Certainly, right. And those are two dramatically different items. I would, an ESOP, I view an ESOP as a form of a financing structure, the way I think about it, wrapped around an employee, an ERISA retirement plan. A lot of rules surrounding that. It does have some ownership, potential shareholder advantages on selling your shares, some tax kind of deferrals that you can put in place. Probably not enough time on this call to go through all of that, but I think that would be one of the primary differences. Selling to private equity versus selling to a strategic buyer or things like that has some of the typical things about structures and all that. But I think the bigger difference is on an ESOP is what we're talking about. There are some fundamental differences there that you wouldn't necessarily get on a on a sale to, let's say, a private equity. But I would tell that question, if someone wants to, reach out, that's something we can provide some more information on. It's just probably a little more detailed than we can get into here on this call, but certainly are some key differences.
And we have some resources that kind of compare ESOPs to M&A, which I really think is kind of the question, less private equity, but just a third-party buyer versus ESOP. We have some. If you come to our website, we've got some thought leadership around that, because while there's tax savings, there's also valuation trade-offs that are built into the structures to consider.
Hey, great, thank you. I put you guys on the spot a little bit. You guys did awesome today. I'm going to give you each just the opportunity. Any closing remarks? Dina, we'll start with you before we wrap up. If you got any closing remarks here.
Yeah, just kind of echoing, what I said at the beginning of the call. There's a lot of money chasing a lot of opportunities right now. And we're really trying to educate and urge people to sit down and think proactively and opportunistically about an M&A transaction. I would imagine many business owners who are in today's session have received phone calls, letters, emails, also seen some really creative ways that they're being solicited by acquirers, right? And And that's pretty reactive. We always encourage folks to be proactive and be thoughtful and strategic, engaging all of these great advisors that we have on our panel today in preparation and creating a strategy, not just reacting to something that kind of sounds nice. I actually heard that from someone. Well, I got an offer and it sounded kind of nice. I'm like, ooh, let's think broadly and more profoundly about it. And doing it, and the reason I say that is because the market is in a place of abundance. There's a lot of opportunity available, and but there are many ways to do it as well. I often use the metaphor that M&A is like Baskin Robbins. There's 31 flavors. So back to questions that we talked about earlier on what do you need personally, where can the business go, answering those questions will then dictate which flavor you should choose, which flavor is appetizing to you. A question just a moment ago about ESOP versus M&A, or, there's so many different ways to minority buyouts, majority buyouts, debt, there's so many ways to think about how to structure a transaction. And it makes sense to, while opportunities are available, to look at them. You can look at them and still decide you don't want to do something, but it's better to know than to not, because we are headed into some pretty significant economic headwinds that I think are going to start to affect valuation, value, not volume. The money is there, so deals will happen. That all has to go somewhere, but I think value is going to drop a bit because we're going to start to see some of the macroeconomics start to affect transactions. And if that's the case, and don't be in the position where like, I wish I would have thought about this 12 months ago. Start now. And if you decide not to do something, so be it, but at least you went through the exercise of the planning and the strategy and whatnot, because it'll just make you all the more smarter and more prepared in the future for when and if you do decide to do it.
Thanks, Dina. Doug, I'm going to jump back over to you. Any closing remarks from you?
I think just keep in mind if there's an impediment to the deal and you want the deal to go smoothly, quicker, better, more efficiently, remember insurance, even though normally people don't think of that right out of the gates. And think of it as early as possible. Give us a call confidentially in advance, and we can kick it around and see if there's an opportunity. And think of it more as a strategic role rather than a risk transfer role, even though it certainly has that risk transfer element to it. It's very strategic in nature to really help facilitate the deal, get it done quickly and efficiently.
Thank you, Doug. Over to Mark. Any closing remarks?
Yeah, I guess if I was giving a couple, I would encourage any business owner to whether they've got their outlook is 5 years or 25 years, think about succession, have those discussions early, understand a value of their business, right? And how a value might be determined by somebody looking at it. And if that's their goal, I've always been amazed. We dutifully put together balance sheets and income statements and stuff like that every year, but how many people really sketch out, well, what do I think my value of my business is? Did that go up or down? And it's not really the absolute value that matters, but am I moving in the right direction, right? I would say those kind of things. I would say the other thing on businesses is usually, a lot of times there's a family aspect to it, right? And family matters. So, don't forget that aspect of it when you're dealing with all the numbers and things that go around. And then I guess finally, I would say, get good people to help you. When the time's right, get good people that are experienced. You might have people you've worked with for 30 years, but maybe they're just not experienced in transactions. And that's okay. They can still be your counsel, right? You can still trust them. You can still be part of it, but get people who've worked through this before, right? Would be my other thought. So.
Yeah, great advice. Appreciate that, Mark. And then Brady, we'll close with you.
No, I think this group captured it well. It's an amazing group. And the only thing I would do is thank you, Jim, for putting this all together and hosting it, and for William Vaughan for organizing. So we appreciate it and appreciate being part of it and having the opportunity to share some thoughts today. So thank you.
Yeah, great. And thank you guys, the panelists. Thanks all the participants for taking your time. I know there was a couple of notes in there about how they get in contact with you guys if they're thinking about it. So when we send out the presentation materials, the contact information for our panelists will be in there as well as the companies that they represent. And certainly, should you have questions beyond this, don't hesitate to reply or contact us for those as well. We can answer those individually. The other thing is, guys, we are collectively with William Vaughan and with Kapnick and TDC working on some more webinars this year. So keep an eye out. There should be some really good and interesting topics. I think cybersecurity is coming up, and they're always going to be relevant, hopefully, to the time that we're in. But thank you all again. This will conclude the webinar, and hopefully see you all soon.